there is something called consistency. What it means is there are two ways you can look at consistency. One is consistency, the other is also called comparability. Consistency means similar items should be treated similarly. For example, when you take raw material that you have purchased, when you are making your assessment at the end of the year as to what is the value of that raw material, and you say I will take it at cost of my purchase, then the finished goods also, which form in the same family, should also be taken at the cost. You cannot have a situation where the raw materials are taken at the cost and the finished goods are taken at market value, or the other way around. Both should be same. Now that is called as consistency in treating consistency in accounting. Comparability means that year after year I should use the same principle. Suppose I have now used the principle that I am going to use the cost of raw material and the cost of manufacturing the finished goods as the basis on which I am going to value the stocks that I have at the end of the year. In which case, year after year I should take the same. I should not change it from cost to market value at a later date. Now that is what the consistency and the comparability say. Year after year it should be the same. Within the same group of assets or liabilities, you should treat them in a very similar manner. The offsetting principle says you cannot offset an income and expense. For example, you have put some bank deposits and you also have a bank loan. In on bank deposits you may be getting interest, and in on bank loans you may be paying interest. Now you cannot offset the interest income against the expense. You have to show them separately as income received as by way of interest and income and the expenditure by way of interest. A business entity concept, this we have seen. We have said that from accounting purpose, the owners are differentiated from the business. Be it a sole proprietor partnership or a limited company, the owners are different. The business is looked at as a different entity. That is why when the owners put capital into the business in turn, it is assumed that owes that money back to the owner, and that is why it is shown as a liability in the balance sheet that we saw before. Materiality is very important, because otherwise the cost of making assessments and reporting becomes very expensive. Let me take an example. Suppose a particular firm has about 1 crore of rupees worth of stocks. It makes an assessment that about 20 or 25,000 rupees of worth of stocks might have become obsolete. Now should it now go about reporting that, or is it okay to not report? So in the overall scenario, a 20-25,000 rupees stock becoming obsolete in a 1 crore stock may not be very material, because it will not impact your profitability in a base. So materiality is looked from the point of view, is it going to affect the financial picture in a major way? If it is not going to affect, it may not make a much difference to the financial picture, because I didn't consider this 20-25,000 rupees of stock which has become obsolete, then it is fine. But at the same time, in a 1 crore scenario, if 6, 7 or 8 lakhs of stock has become obsolete, then it may become material, because it may impact the profits of the company in some manner. So that is how the materiality part of the accounting concept is to be treated. Duality basically means that any transaction that happens in a business has two effects. Now this we will see in the course of our discussions, maybe a couple of chapters later, in much more detail, and I will leave it for that time and not get beyond just saying that any transaction has two-sided effect, and that both the sides of the effect have to be captured from an accounting perspective. Having looked at the concept, let us also look at what are the other desirable qualities of accounting. One is relevance. Now it is important that the kind of information that is presented is relevant to the end user. We saw a list of end users before. It should be relevant to them. It should not be something that is not relevant. Understandability. It should be presented in such a fashion that the users can actually make out from that information what they want to know, rather than put it in a very complex fashion where they are not able to find out what the information they seek. reliability, which basically means that can I have a third party going through the accounts and saying that yes, all those concepts, all those rules and procedures that were to be followed have actually been followed by them, and it presents a reliable picture. Completeness means that to ensure that nothing has been left out, and everything that is material, that everything that should have been talked about in the financial status, in the financial report, has actually been done. A fair presentation. A fair presentation is where the treatment of various types of transactions, the economic events that happen in a business, the transactions that happen in business have been done in a fair manner. Now this is where accounting bodies like Institute of Chartered Accountants, etc. come in, where they lay down what are known as accounting standards. They say how different types of business transactions should be treated and how the accounting of these particular transactions should be done. This is to ensure that there is consistency across business as to how they approach each type of transaction. Of course, there can be a lot of difference of opinion, industry to industry it could differ, but then that is the purpose of fair presentation as well as faithful representation, in the sense that there has been no mala fide intention in putting up the accounts in a wrong fashion, in a fashion where the information provided is wrong, the information provided is not the information which the end user may want, or it is something that has not been correctly projected in the financial statements. We have a small video clip which we will run through on these accounting concepts before going ahead.
So we'll start with the assumptions. The first assumption underlying financial reporting is separate economic entity. Economic events are associated with a business entity and are separate from the owners of the business entity. The second assumption is going concern. The going concern assumption assumes that businesses will continue in the foreseeable future. This assumption is necessary because it allows us to not worry about liquidation values when we're preparing our financial statements. The next assumption is the stable monetary unit. Financial reports are prepared using a stable monetary unit, for example, the US dollar. In periods of extremely high inflation or extremely high deflation, the financial statements are less relevant because the monetary unit changes so drastically during those time periods. The last assumption is periodicity. Accounting reports are prepared periodically. For example, accounting reports are often prepared monthly, quarterly, or annually. The periodicity assumption allows us to break the business's life cycle into these time periods and prepare financial reports associated with the time period indicated, either monthly, quarterly, or annually. Next, we'll discuss the principles underlying financial reporting. The first principle is the historical cost principle. Assets, which we'll later look at in more detail, are reported and presented at the original cost, and no adjustment is made for changes in market value. While financial statements have historically been prepared based on historical cost, that's not true for all assets. It is true for most assets, and as we study the different types of assets, we'll identify when historical cost is used and when we use other measures for reporting assets. The matching principle indicates that expenses and revenues will be reported in this period incurred and earned. We're going to study expenses and revenues in more detail later, but matching says we'll report expenses and revenues in the period in which the expenses were incurred and the period in which the revenues were earned. The revenue recognition principle, also referred to as the realization principle, indicates that revenue is realized when the good or service is provided. Now, realized means reported on the income statement. The final principle is the full disclosure principle. The full disclosure principle requires that all information about the business entity that is needed by the users is disclosed in understandable form. That's not to say that every possible thing is disclosed, but everything that's needed by a reasonably informed and educated user is provided in the financial statements. The conventions that we use include materiality convention. Materiality relaxes certain GAAP requirements. Remember, GAAP is the rules that we follow if the impact is not large enough to influence decisions. And the question that you ask yourself in determining if something is material is, does it matter? Would reporting a particular item in a certain way change the decision made by a user? If the answer to the does it matter question is no, the decision wouldn't change, then the reporting is immaterial. The cost-benefit convention also relaxes GAAP requirements if the expected cost of reporting something exceeds the benefits of reporting it. Remember, we are still obligated by regulatory and legal requirements, but the cost-benefit convention does allow for the relaxing of certain GAAP requirements. Finally, industry practices convention. Industry practices should be followed even if they differ from GAAP. Oil and gas is a particular industry where there are some very unique accounting standards.